Hello, hello, hello. It is Thursday, and it is time for Thursday Tax Tips with Beta Virtual Assistant, where we love to talk about crypto, we love to talk about investing, and we love to talk about crazy things that happen in the world. So, all of those things. And I'm just so impressed from the other day because 70 people ended up liking our video, which I love. I think they were the wrong crowd, but that's okay. We'll take exposure when we can get it. And if you have questions about crypto taxes, I am here. I am trying to watch the comments, and you can ask me anytime. You can also message us and all that sort of thing. All right. But today I thought I would talk about the different kinds of crypto income that there are and what the implications are of your different investments that you make in crypto. So the main one that everybody knows is the buy and hold strategy, which is in crypto, we end up calling that hodling. Hodling, the myth is because some drunk trader couldn't type well, and so he said he was going to hold on to his Bitcoin, but he switched the D and the L. Now we call it hodling. So what are the tax implications of hodling your Bitcoin, or whichever crypto? And that depends what you are going to do with it. So if you hold it a long time, if you hold it more than a year in most countries, including the United States, that crypto investment, when you sell it, will actually qualify for long-term capital gains. Why is that cool? Because usually long-term capital gains means lower tax rate on your capital gains that you're paying, so you pay less in taxes. So that is very, very cool. However, you do have to be careful because if you say, for instance, you buy and hold your Bitcoin in one account, but in another account, or even in the same account. If you did this in the same account, it would be really bad. But if you were also running a bot, now the bot is like the opposite of hodling. A bot is making hundreds of trades per minute, depending on the day and depending on the coin and depending on the parameters and all that sort of thing. And guess what? If you're making hundreds of trades per minute, you're actually making a lot of short-term trades, and that means you are taxed usually at the highest rate of income tax for your country. So here in the United States, that would be based on all of your income added together would qualify you for, I forget the different levels, but I know it caps out at 37%, supposedly. But then in the United States, they like to make things extra confusing. So they throw on an extra 3.8% tax if you're doing such and such or other thing. And then, of course, that is just federal tax. That isn't even including state tax. So already you're up to 40% of your gains gone to taxes because you were doing short-term trading. And that would be when your income is pretty high. So either you're making a lot of money from trading, or maybe you have other businesses that are pulling in a lot of money, or you have a high salary. In any of those cases, those are taxed at the short-term regular income rate, which is the highest you can go. Except for if you actually have a business, a self-employed business, and you have to also pay self-employment tax on it, that would be the highest tax rate you can go. But that's a different story. Okay, so if you're holding on to crypto, definitely paying lower income tax rates, which is good. And if you are not holding on to crypto, if you are trading and turning it over, that is definitely the higher ones. What about if you find a strategy where you can stake your crypto and it will actually pay some crypto back to you? And that crypto is usually taxed at the short-term higher income rates because it's considered income, and income is all part of that magic formula to figure out what your rates are. However, if you deposit crypto, so say you deposit crypto into a protocol of some kind and you leave it there for over a year and then you pull it out, like for instance, you might think about these people who invested in this drip faucet. So the way the drip faucet works is you go and you deposit your crypto into the drip faucet, and like technically they say it's sacrificed and you're never going to get it back. But at the same time, it pays 1% a day of passive income is how some people describe it, which really means they're giving you 1% of what was in there back to you. So you put in 100 drip, you get 1 drip each day, I think, if that's how it works. In any case, this is where people get confused though, because is that 1% you're getting a day, is that actually income that you report and that you have to pay taxes on, or is it a return of capital? Because let's face it, you put in 100 drip, shouldn't you get credit for having that 100 drip in there? And then when the drip is coming back, at least for the first 100, shouldn't that be just a return of capital? And that is the argument I like to make for my clients. And I would totally be willing to stand up to whoever comes after you if they come after you and they say, you can't claim this as return of capital. And you say, well, okay, explain to me how I put in $100, or like talking bigger numbers, it really becomes obvious. If you put $10,000 into a protocol and then you're getting paid, you know, $10 a day, $100 a day. Well, okay, great. But at the end of the protocol, if it works that way, you should get back your 100,000. Did I say 100,000? $10,000. You should get that money back. And if you're not getting that money back, then I don't think that all the stuff that came in is actually income. I think it is return of capital. And that means if it takes a long time for that drip to drip back to you, wonder why they call it drip, then you'll have a greater chance of actually holding onto it long enough to qualify for long-term capital gains. And then you can have those gains when you finally sell the coin. If you've held it longer than a year, then you get the lower income tax rate. Of course, that doesn't work in this particular instance, at least at the moment, because drip started off being really expensive and it has gone down. I think it was down to 3 cents last week. So yeah, not exactly going to pay off. And actually, I think it is really beneficial to set off your short-term income with short-term losses. So if you can sell things at a loss at that point, then you pay less in taxes because you're offsetting the most expensive part of your income tax formula by offsetting the short term. Anyways, okay, I get really nerdy when I go into things like that. So if any of that doesn't make sense, you know how to reach me and where I am and all that sort of thing. You can always message me. Catch me here Tuesdays and Thursdays at 4 p.m. Eastern or Saturdays at 10. Let's see if there was anything else I wanted to talk about. So hodling, staking, interest-bearing, long-term, short-term, gains and incomes, return of capital, all of these things, it's all kind of a mix. And you want your tax software to be telling the right story. So a lot of people who might be putting money into a protocol like Drip, and then they have these deposits come back into their wallet, and their tax software doesn't know where it came from, so it gives it no cost basis, which is the same as realizing it as income. And then you're paying full 100% capital gains on that instead of the return of capital, which we like to use. So we always go through our clients' taxes and make sure that the taxes are telling the right story and that the return of capital is actually showing up as return of capital and not as like 100% capital gains. Because we've got some clients who like they put a lot of money into these things, and then to get the money back out and then pay taxes on it because the tax software didn't recognize it correctly, that would really be unfortunate. So that's what I have to say about that. In other news, our friends at Breakout Solutions, we have a relationship with them a little bit, and they have this great YouTube channel where they're talking about crypto and investing and all the things that they do. They actually teach people how to do some of the protocols like Drip and things like that. But today they put up an interview with actually a friend of mine who went through this kind of horrible incident in July where her banks like froze her money and she couldn't get it out, and they told her she was in a scam and all these sorts of things, and it was just kind of crazy. And it's really evidence of what is going on in the world and how we really have to be on the watch for the governments and the banks trying to control our money when it's our money. And she talks about in the interview how it turns out that when you deposit your money into a bank, it's not actually your money anymore. You are a creditor to that institution, so they are supposed to pay you back when you want your money. But if something happens and they don't, it's like, isn't that interesting? So definitely check out her interview. We did post a link to her interview somewhere in our chat on our Beta Virtual Assistants page. We also posted it on our cross-posting Safer Crypto Investing page. I think it's a really interesting interview just because these things are happening, especially in Australia. They are really trying to force everybody into a cashless society. And they're trying to do that here in the United States too. And it worries me because you know, if you don't agree with the government and the government controls all the banks and the banks control your money, then, you know, you end up living in a shack by the river, you know, who knows? So if you are interested in staying aware of these things and doing what you can to make sure that that doesn't happen on your watch, definitely check out that interview. And I don't know what you can do from that, but being aware of it, spreading the word and all that sort of thing is a good thing. And that's what I have to say for today. And I don't see any questions, so I'm going to say we are done for today. Again, we're here Tuesdays and Thursdays. If you have questions about your crypto taxes, we love answering those. And we would love if you actually have a question and message us or send us an email or something like that. We do have a brand new course. There's a link in the description explaining just enough of the taxes so that you can figure out if you need help or not. Like if you have purchased crypto and you realize that you do technically need to report it to your country's government, it explains just enough about that and enough about the different parameters and things to think about so that you can determine, hey, my taxes should be really easy. I can totally do this on my own. Or it might be like, oh, I had no idea that my situation was so complicated and I definitely need to be checking in with somebody who can help me. So check it out. It is free for now, especially if you open it and actually watch it and check off the things in the first 3 days. If you claim it and don't do anything with it, it goes away. Bye-bye. So I'm super excited and I'd love to hear your feedback about it, if it was helpful or if it could be better, or if you didn't know that about taxes and all that sort of thing. And I think I've jabbered on enough for today. So I will sign off, but have a great week. See you here on Saturday at 10 a.m. and stay safe out there. Watch out for your money. Don't put it all in the bank. It's not safe. Find someplace else. I'm not sure where. And check out that video. All right. See you later.